A global financial shakeup, the impact of U.S. credit risks. In a dramatic turn of events, global bank stocks took a hit on Friday, sparking concerns about credit quality and the stability of the banking sector. This development has sent ripples across the financial world, leaving investors anxious and seeking answers. The recent disclosures by Zions and Western Alliance in the U.S. have raised fears, reminiscent of the 2023 banking turmoil. With equity valuations already high and investors on edge, the situation is ripe for controversy. The banking sector's exposure. The banking sector's involvement in 2 U.S. auto bankruptcies has brought back memories of the Silicon Valley Bank failure in 2023. High interest rates. European banks take a hit. European banks SX7P witnessed a sharp decline, with heavyweights like Deutsche Bank, DBKGN.DE, and Barclays, BARCL, sliding by around 6%. Societe Generale SOGNPA also joined the downward trend, falling by 4.6%. This sell-off spread across Asia and Europe, with Japanese banks and insurers IBNKST, INSUT, taking a significant hit. The impact on U.S. markets. In pre-market U.S. trading, the SPDR-SP Regional Banking ETF, KREP, dropped by 2.4%, following a 6% tumble the previous day. Zions Bancorp, ZIONO, at the center of investor scrutiny, saw its shares slide by 1.7%, mirroring the decline in big banks. The sell-off was triggered by Zions' announcement of a $50 million loss on commercial loans and Western Alliance's WAL-N disclosure of a fraud lawsuit against Cantor Group V, LLC. These events, while seemingly isolated, have raised eyebrows due to their timing after the collapses of First Brands and Tricolor. Private credit risks and market concerns. The failures of First Brands and Tricolor have shaken investor confidence in private credit, a rapidly growing yet less regulated market. Mark Dowding, Chief Investment Officer at RBC Blue Bay Asset Management, highlighted rising credit impairments and default rates, reaching 5.5% in the latest available data for Q2. Additionally, where credit events have occurred, we've seen a weakening of covenants and investor protections, suggesting larger losses on default compared to historical norms. Dowding added, a cautionary tale from J.P. Morgan Chase. Jamie Dimon, CEO of J.P. Morgan Chase, warned about credit markets earlier this week, stating, when you see one cockroach, there are probably more. Everyone should be forewarned. Broader market implications. Vasu Menon, Managing Director of Investment Strategy at OCBC Bank in Singapore, noted, investors will recall how issues with regional banks in 2023 led to a sharp decline in global bank stock prices and broader global stock markets. While big U.S. banks have reported strong earnings, the high valuations across equity markets have left investors on edge. European bank shares SX7P are up by around 40% year-to-date. While world stocks have risen 16%, MIWD 000PUS, driven by investor interest in AI-related companies. However, concerns about the rally's sustainability have emerged, with periodic, sharp falls and gains for safe haven assets. Tensions between the U.S. and China have also contributed to stock market volatility. Market reactions and safe havens. Investors are now fully expecting a U.S. rate cut in October, leading to lower government bond yields. The Swiss franc, a safe haven currency, has appreciated, while gold hit a fresh record high, setting the stage for its best week in over 17 years. As the situation unfolds, the question remains, are we witnessing the beginning of a new financial crisis, or is this a temporary blip? What do you think? Share your thoughts in the comments below.